The interest in PLTY cover call fund by YieldMax is exploding. And yet, I have rarely seen a more sharp divide in opinions on a cover call fund like PLTY. Some see it as a goldmine or like a ticking time bomb. In this video, let's take a close look at PLTY distributions, returns, and risks that investors should not overlook. With stakes this high, a lot will depend on what happens to Palantir stock from here. Let's start with Palantir. Over the last year alone, PLTR price appreciated by over 300%. Palantir takes its roots as an AI-based software company. It began offering surveillance and military-related solutions for the US government. The biggest selling point of Palantir is this: its software takes complex, disparate data, cleans it up, and provides actionable insights. Its machine learning algorithm called Ontology is at the heart of this all. Unlike Meta and Alphabet, Palantir is not collecting and monetizing user data. Palantir is a full-fledged AI-based software company. In fact, any data that its software processes stays with its customers. Things have changed in a huge way for Palantir in 2023. Before that, investors viewed Palantir as just another US government contractor. But in 2023, Alexander Karp, the outspoken CEO of Palantir, made a big announcement. The company was ready to offer its software solutions to the private sector. Palantir released the so-called artificial intelligence platform. With that, private companies can use Palantir solutions too. Was this a humongous success? To say so is to understate where Palantir is heading. Let's take a quick glance at some numbers. Revenue growth was impressive before. After a notable slowdown in 2022 or 23, Palantir is growing its top line again. The more granular zoom in paints a better picture. Since 2024, the quarterly growth rates are accelerating in a big way. The US commercial segment especially saw a rapid growth that jumped to a whopping 93% in the last quarter. The US government segment also saw a large growth of 53%. As of now, revenue from commercial customers accounts for 45%. Note, it started virtually from nothing a few years ago, and Palantir is only at the beginning of this growth stage. But not only that, Palantir is a money-printing machine. Its profitability has shot up big time. In 2023, the operating profit margin turned green and has expanded threefold in the last 2 years. The operating leverage is material for Palantir. In other words, as its revenues scale up, its expenses will not scale up by as much. Everything left falls to the bottom line, leading to profit margin expansion. This rule of 40. It has to do with summing up a company's recent revenue growth and its adjusted operating margin. And some investors use this rule of 40 to assess the financial health of a software company. For instance, here's a graph showing this metric. We see that there are a large number of companies above 40. Here, Meta, Alphabet, and some others. And here's Palantir. Nvidia is still a king with over 122% reading. But Palantir reading of 94% is huge. The metric is not perfect though and may mask high-growth companies with mounting losses. The obvious question is, how sustainable are these breakneck growth rates for Palantir? And here we must talk about competitive advantage for this company. It basically comes down to this question is, what are the features of Palantir as a company that are very hard or impossible for its competitors to replicate? If we look, there are solutions like Amazon AWS, Snowflake, or ServiceNow. They also develop their own analytical tools. But Palantir differentiates from these companies and services in a big way. Maybe it is the only AI company that can sift through complex datasets for decision-making. You can look at data all day long and see nothing. But Palantir machine learning algorithm can detect opaque but significant relationships, and then it turns them into actionable insight. That's unique, and few companies offer such solutions at scale comparable to Palantir. Now, of course, Palantir's clients can attempt to develop these analytical tools themselves, but that's a very daunting and can be very expensive task. And that is especially true if you are a small enterprise. For instance, there's a structured data that you can put into Excel like numbers and such. But what about unstructured data like emails, reports, videos, or images? And the list goes on and on. How do you process and derive insights from this data? On top of it, it must be understandable and actionable for a non-technical user. And all this is easier said than done. Palantir's years of experience in data analysis give it a first-mover advantage. For instance, take Tampa General Hospital that partnered with Palantir. The hospital was able to reduce its patient stays by 30% with Palantir. That's a material improvement and directly translates into better profits. So, when efficiency gains pile up for Palantir's customers, the switching cost mount. In other words, if a customer abandons Palantir services, it won't see those efficiency gains anymore. Just buying and not renewing with Palantir is pretty much not an option. Palantir continuously improves its algorithm, providing an edge to its customers. Once a company realizes these efficiencies, it gets hooked. Net dollar retention metric is a useful tool to gauge Palantir's switching cost. And it actually looks at the dollar spent from the same customer from one period to another. The most recent reading is 128%. In other words, a customer who spent something like, let's say, a year ago, now spends by 28% more. And that's one of the highest readings among software companies. And this growth in retention metric likely comes from new products or upgrades that Palantir upsells to its customers. One very clever thing Palantir did was a bootcamp strategy for sales and marketing. The company stages an event for prospective customers. Anyone can come in and see how Palantir's software works and its benefits. Bootcamps offer a large number of touch points that people can interact with. That's a very unique way of fueling growth. But not only that, the word of mouth takes a center stage. Many CEOs of US corporations know each other, and so once they see results from Palantir, they may tell to their friends from other companies. And so the virtuous cycle starts. Palantir trades at stratospheric valuations. Its price-to-sales ratio, for instance, stands at over 130. For comparison, Nvidia sports a price-to-sales of 27. So there are a lot of growth expectations baked into these numbers. The biggest unknown is the total addressable market for Palantir's products. In other words, we don't know what's the potential revenue from AI software products that Palantir offers. It could be trillions of dollars for all we know. Even small changes in assumptions lead to huge changes in valuation estimates. For instance, what if Palantir accelerates its overseas expansion? For now, the company derives most of its sales from the US, but that can certainly change. On top of it, it's no secret that Palantir is shut out of markets unfriendly to the US. We can safely count out China and some other big countries. I quickly ran numbers to justify the current stock price of 180, and what I see is that Palantir will have to double its operating margin and have a revenue growth in the realm of 70 to 90% in the next 5 years. And that's pretty much very close to what other analysts are saying, like let's say from Morningstar. This could be doable. There's a very strong bull case for Palantir, but the way it gets there may not be a linear path. In fact, even small revisions to growth estimates may lead to sharp declines. Do you remember how Nvidia sold off by over 60% in 2022, only to skyrocket 17-fold from that bottom? That can happen to Palantir too. Either way, I would be very cautious with holding PLTR or PLTY. It is important to understand Palantir and where it's heading from here, and I only scratched the surface. If you don't have a bull case for Palantir, there's no point of investing in PLTY. Now, let's examine PLTY. Like many other YieldMax funds, PLTY does not hold Palantir stock directly. Instead, it relies on synthetic positions for that. They provide exposure to stocks by buying call and selling put options at the same time. Both options must have the same expiration and strike price as we see here. Synthetic positions are like holding Palantir stock, but they incur some cost. For instance, you have to periodically roll over those synthetic positions, which entails some trading costs. Also, at times, call options can be a bit pricier if there's a strong bullish sentiment payment on Palantir stock. And so these costs can pile up here and they're in addition to PLTY's expense ratio, which stands at 1%, which, by the way, is quite high. Also, these synthetic positions are collateralized with treasury bonds, as we see here. They help PLTY offset the holding cost of their synthetic positions. As for derivative income, PLTY holds covered call positions for the most part. They sell call options and get premiums that they distribute to shareholders. These positions are highlighted in blue here, but this income comes at the expense of capping PLTY upside from Palantir stock rallies. For this reason, the fund does so-called credit spreads. They also buy out-of-the-money call options. They're highlighted by red here. By doing so, they can take part in upward moves and mitigate upside caps from covered calls. One of the main reasons why PLTY goes after PLTR stock is its volatility. The 30-day implied volatility for Palantir stands at around 49. This means that Palantir stock can go up by 15% in the next year, but it can also go down by 13%. In comparison, Nasdaq 100 comes at implied volatility of 17. That's almost 3 times smaller. High volatility for stocks is a two-edged sword. It brings more premium income, but it also means more downside and more up and down movements. Next, let's look at distributions. Current distribution yield stands at above 90%. However, this number comes from the most recent monthly distribution. Long term, these high distributions are unsustainable unless, of course, Palantir stock will get on the unstoppable and forever rally. So net asset value or NAV erosion risk is a given for aggressive derivative income funds like PLTY. It happens because ETFs must distribute realized income on a regular basis to investors by law. And so when there's a down day, it may happen that PLTY may dip into its capital. In other words, it will give your money back. If we look at PLTY stock price, it is up since inception. This is thanks for that massive rally Palantir stock went on over the last year. This has helped PLTY a lot to sustain its distributions. But what if Palantir starts whipsawing or its upward moves are less pronounced? Then you can count on NAV erosion for PLTY almost with certainty. Right now it looks like a small and distant problem, but if you notice NAV erosion, then reinvesting your distributions may be necessary if your goal is growing income. How much to reinvest depends on your personal goals and how much of a consistency and growth in your distributions you require. Next, let's check on PLTY total returns. Since its inception, PLTY generated almost 170% return, assuming 100% distribution reinvestment. That's massive, and thanks to Palantir stock more than quadrupling. Also, as expected, PLTY lagged behind PLTR due to its upside gap from call spreads. The gap is pretty large at around 2 times. And that's the main argument against holding PLTY. If you're bullish on Palantir, then holding its stocks directly may give you a better deal and better returns down the road. And also that way you can actually institute your own self-distributions by selling stock of Palantir. And that way you'll be 100% in control of income timing, but also taxes, if that's relevant. Now let's talk about taxation. Holding PLTY in a tax-deferred account doesn't matter because anything you withdraw from, let's say, 401k will get taxed as a regular income. But holding PLTY in a taxable account is a different matter. There are 3 sources of income for PLTY shareholders. The first one comes from those cover call position premiums that the fund generates. The second one comes from those synthetic positions that the fund holds on Palantir stock. And the third one is that interest income from US Treasury holdings. When it comes to US Treasury holdings, that income gets taxed as a regular income. As far as the synthetic positions on Palantir stock, they are likely taxed as a short-term gain or loss. I say likely because it depends on the holding period. Looking at PLTY current holdings, its synthetic positions expire in less than a year. If PLTY rolls them over at a gain, the gain gets taxed as an ordinary income. If rolled over at a loss, the short-term capital loss is realized. Cover call premium income is usually taxed as a regular income too. PLTY aggregates income and losses from its cover calls, synthetic positions, and treasury interest income. At the end of the year, they report it to you on your 1099 form. For instance, in 2024, PLTY reported almost 96% of its distributions as ordinary income. The remaining 4% were a return of capital. If the fund lost money but still made distributions to you, those distributions count as a return of capital. And a return of capital is not taxed. Instead, it first reduces your investment cost basis. Once your investment cost basis gets to zero, then all future distributions will be taxed as an ordinary income. So, in a sense, return of capital turns your distributions into tax-deferred long-term capital gain. That is, assuming that you are holding PLTY stock for more than a year. 2024 was an exceptional year for Palantir stock, and hence over 90% of your distributions from PLTY were a ordinary income. And 2025 is looking similar, unless Palantir stock goes on an epic fall. Count that your distributions in 2025 will also be ordinary income, and this makes PLTY and holding it in a taxable account very tax inefficient. Investing in PLTY has its pros and cons. It's a single stock fund, so a lot will depend on how Palantir will execute its business strategy. It has done exceptionally well so far, and its bull case is very strong. But there are questions about its valuation. Even small missteps can lead to sharp corrections. And that's my main concern at this point. And that's all for this analysis. I hope you learned something new today. Like and comment if you have a question or you enjoyed this video. Also, subscribe to my channel for more weekly content on investing. I will see you next time. All the best!